So Rebecca's been a licensed CPA actually since 2002. If you just think about like what were you doing back in 2002, like me, I was in like fourth grade. Okay, so that really speaks to something. Okay, like 2002, we're talking like the beginning of George Bush, right? Okay, so that was a while ago. That was a wild time. She's from Kansas City, Missouri, where she generated $500,000 in sales annually. Wouldn't it be nice to have $500,000 in sales annually? Her firm specializes in tax reduction. She mentored and groomed one of her employees who actually took over her business in Kansas City in 2021. So I think that's really cool that she was able to actually bring up one of her employees as well. When you think about what makes a great leader or what makes somebody who you want to follow, it's somebody who brings up people that are around them. So I think that that's really awesome as well. To date, Rebecca estimates that she's legally kept more than $5 million out of the clutches of Uncle Sam for business owners, into the pockets of middle-class business owners. So one thing that she does is specifically works with middle-class business owners. I think Coeur d'Alene has a couple of those. Yeah. After selling the business, Rebecca bought a Ford F-450 dually truck. I actually asked her to meet me in Spokane the other day, right, where we have contact parking only and you have to pay 2 hours for parking at a time, right? And her Tesla wasn't running at the time, or her Tesla wasn't exactly reliable, right? So she took her Ford F-450, right, all the way from St. Mary's, drove it to Spokane, had to drive around, find a parking spot and everything like that. So I think if you can do that, you can do anything. Because I drive a Chrysler 200 and I can't find a parking spot. She mustered every ounce of courage she could find and set out to travel full-time in the RV for about a year. She had plans to buy land in the country with some acreage and build a home. While traveling, Rebecca used a program called Harvest Host. Has anybody ever heard of Harvest Host? If you haven't, you're going to think this is cool. It's like Airbnb, but for RVers. Harvest Hosts connect rural businesses like farms, wineries, and travelers, giving them a free place to park overnight. So I thought that was really cool. Like, can you imagine just traveling around and parking at all the different wineries, and then, you know, you're like, hide the keys. One of the places that she stayed was a farm that belonged to a former real estate agent. He showed Rebecca the land that she ultimately purchased, a beautiful property with stunning mountain views. She fell in love with the property and the former real estate agent, Pete, who is now her boyfriend. Isn't that like a match made in heaven? And so she actually told me, like, he lived right down the road from the property that she showed him, right? Or that he showed her. Yeah. And he was a former real estate agent, just showed her the property. Now all of a sudden they've got acreage together, right? And so I just think that that's really beautiful, you know. She moved to the area in March of 2022. She lives south of St. Mary's on 27 acres, and she just completed her house and decided to relaunch her business in Coeur d'Alene. She's excited to bring her skills and knowledge of tax reduction to the community and help business owners keep more of their hard-earned money. Welcome, Rebecca.
Thank you so much. Well, thank you for letting me speak with you guys today. Like he said, I really specialize in helping the middle-class business owner. So the things that we're going to talk about today are things that we can hopefully all relate to. These are real things that we all have on our tax returns and they're opportunities that we can all take. So I'm not going to be talking about millions of dollars in tax savings and strategies that are beyond your reach. What I do in my business is I not only strategize and help business owners plan, but I do take you by the hand and walk you through the actual implementation of each of these strategies. And there's hundreds of strategies out there. I'm just going to go over a couple today that I just tend to work on with clients a lot. And I'm just going to give you a glimpse into what I do when a prospect walks in the door and what that maybe first strategy meeting might look like. So you can kind of get a feel for what could be possible if you did plan. And I want to ask you guys a question. So how many people here feel confident that you are paying the least amount of taxes legally possible right now? Not anybody? Well, there's a lot of laws out there and it's very confusing, right? And we know that there's lots of opportunity. So there's just so many people like you. And my goal today is to get you thinking about why that is and what would need to happen for you to feel that way. I'm going to tell you the truth. Honestly, all of my clients feel like they are saving the most, they're paying the least amount of taxes possible legally. And I know that for you right now that might seem crazy, but that is their reality. They feel really good at tax time, When we do a tax return, it's a celebration of all the work we did throughout the year. And I can tell you that before I started planning with clients, when I would prepare a tax return for a client that I only saw once a year, in my mind, I'm thinking things like, man, if only they'd have done that. Or gosh, you know, if they just had done these few things, they could have saved thousands of dollars. And it was a frustrating experience for me as the preparer, right? and then I know that these clients don't even know what they could have done. So I had an epiphany, you know, 7 years ago, to really change my whole business model and make tax planning my primary service. And the other stuff, the preparation, the bookkeeping, those things come secondary to it. They're all important, right? But what happens in a lot of accounting firms is that they do take on a large volume of clients, and the more tax returns they prepare, the more money they make, and they're seeing that as their only income source. And so they're so busy preparing returns, there's no time to do the planning. So they actually are in an opposite business model where the preparation is the primary service and the planning comes secondary. So my goal today is to get you thinking differently about your tax situation, and I want to motivate you and empower you to lower your taxes. And honestly, to transform anything in our lives, we have to bring awareness to it, right? So I'm hoping that after my presentation today, you'll have awareness that you're overpaying your taxes and that there's opportunity to do something about it. So, yeah. Okay. So I didn't come up with this example, but it's just a fun little exercise. Some of you already know this one, but and it may not be totally realistic, but if I took $1 and I doubled it every year for 20 years and I didn't have to pay any taxes on it, I'd have over $1 million. And I want to just show you the impact of taxation on our ability to grow our wealth. So if you're taxed at 35%, which is one of the highest tax rates, and basically every time you double your dollar, you have to pay tax on that extra money, right? So at the end of year 20, you only have $22,000 versus over $1 million. Now, what if I could lower your tax rate by just 10%? What if I could bring it down to 25% tax bracket? What would happen then? Just that 10% increases your ability to grow your wealth quite significantly, and now you have $800,000. So it is. It's magic. You know, society teaches us to think a certain way around our taxes, and honestly, society teaches you to not think about it. So you pay as you go. So when you get your paycheck, taxes are already taken out, you've already paid them, they're taken off the top, and whatever's left is what you have to spend on your lifestyle. So most people don't even think about their tax. And if you're your own business and you're not on payroll, then you are still probably paying quarterly estimated payments. So you're doing a pay-as-you-go cycle, or you're setting the money aside in an account as a percentage of your sales or something like this, right? And so that's a particular mindset where you're thinking that I use after-tax dollars for my lifestyle. And what I do with clients is I get them to change that mindset, and it's really a lot of fun when you start doing this. It's kind of like it's fun to save money when you get excited about it and see the results of saving, right? If you see the results of saving taxes, you get excited about it too. And so I help clients to do this model instead, which is I teach them how to spend and save in particular ways using pre-tax dollars, and then using the pre-tax dollars to pay for your lifestyle even. And when you are a business owner, there is so much opportunity to use the earnings from your business for your personal lifestyle. And I'm going to talk about one of the big ones today that we use for that. So I wanted you to just think about your relationship that you currently have with your accountant, and just figure out what is the service that you're getting now, okay? Because there is a lot of misunderstanding about what a tax preparer does for clients. And tax preparers absolutely give tax advice, right? I hear people say things like, You know, I've been with my tax preparer for so many years, and they are so knowledgeable, and they are such a good person that I know that if there was something I could do, they'd surely tell me, right? And so that mindset then means that there's no planning happening because they believe that they're already getting it. But planning takes time. I mean, your health doesn't get better just because you know something, right? You got to do it. You got to learn how to do it right. You need to educate yourself or have an expert to help guide you and take you through that process. So the planning that I'm doing with my clients, I'm meeting with them several times a year, and we are taking certain actions to set everything up correctly so that they are not only saving taxes, but it's all going to get held up in an audit without any issues. So there's so much peace of mind for my clients in the planning process. So a tax preparer is meeting once a year, and they're usually meeting with you after the year's ended, and it's during tax time of the next year. So there's no planning actually possible because the year's already over. So there's really not a whole lot you can do. They are in reactive mode at that point. Okay, Mr. Taxpayer, what did you do last year? Okay, here's the law and here's what we can do on the return based on what you did last year. But there is no planning for how could I have done things differently or better for next year. And I'll have people say, well, I sit down with my accountant at tax season and I ask them, well, what can I do next year? And they do tell me. And then I say, well, did you implement any of those things? No, I really didn't know how to do that. You know, or they got busy and they didn't have anybody to help motivate them or to empower them. So putting the right numbers in the right boxes, that's what a tax preparer is doing during tax season. And then it's a very left brain process, so it's analytical. And I do both of these, so I actually wear different hats. So when I'm a tax preparer, I've got this hat on. But when I'm planning, now I've got my creative hat on. And I'm looking for how can we? And we talk about what are your goals? What vacations are you taking this year? How do you want to save your money? You know, what are your various goals? Do you want to invest in real estate property or you know, whatever it is? And then we talk about various ways that they can set their year up to save the most in taxes. And a lot of times, honestly, you guys, I mean, there's so many times when clients aren't even actually changing much of anything. They're already spending money in certain ways. They just didn't set it up right. They didn't know that they could get all their medical expenses as a deduction through their business. So they didn't. So that's kind of the difference. It's a proactive energy when we're doing tax planning, and there is meeting throughout the year before the year's over. So this is me. Kansas City is where I'm from, and I moved here recently. And I've been, as he said, a CPA for 20 years. And I got my master's degree at University of Missouri, Kansas City. And I even taught some tax and accounting classes. I thought that was a lot of fun when I was getting my graduate degree to do some teaching. And so I continued that even as I was beginning my practice. I taught part-time on the side. And then I sold my business and have just relaunched it here in Coeur d'Alene. And my heart is with the middle-class business owner. And I'm going to tell you, when I go to conferences about tax reduction, I mean, they all say, you know, go after the high-income earners. That's where the money's at. And that's what they teach the CPAs to do. And I decided to take a different road because I know that there's such a need for the middle-class business owner to have strategies that are going to help them. Some work for all of them, and some just work for, you know, there's different strategies that work for you guys versus a high-income earner. So, I mean, I want to focus on that and create a system to be able to help as many people as possible to pay the least amount of taxes. So that's where my heart is. So one of the things we're going to talk about today is the home office deduction or reimbursements. How many here have a work from home or have a home office? Okay. So a lot of you know about this deduction, at least something about it, right? And maybe some of you that don't or aren't, maybe you can. There are some rules around it, but I do help clients to figure out ways that they can take the home office. And I actually honestly can't think of one client I worked with back in Kansas City that didn't have home office. So we figured it out for most everyone. You just have to know what the rules are and find a way to fit yourself within them. But it's a huge deduction. It's a very powerful one. And I say that, a lot of you might be thinking, well, it's not that big. But let's talk about it, because maybe it is bigger than you think.
Does the living room count?
What's that?
Does the living room count?
These are great questions. Yeah, actually, it does have to be an area that is exclusively used for business. So the IRS will never give you the dining room table. I don't care what you say. And the living room's probably not going to work either unless it is exclusively business. If you're a daycare, there's some different rules around it, but otherwise it does have to be specifically for business. But again, I talk that through with clients, and I really bring the real world to the situation. Here's what the law says, and here's what happens in an audit. Okay, so now that you're empowered with all that information, then you figure out how to fit yourself in that, right?
Gonna go down question and answer later.
Yeah, we're going to have some question time. In fact, right after we talk about this topic, we'll have some question time about home office. So, okay. So, first of all, what I'm going to do is just share with you, like, if a client came into my office. So we're going to use Bob as our example today. And Bob brings in his prior year tax return. And what I like to do with prospects is I review their tax return alongside them from the prior year. And I just share with them what I see and what I see as opportunities that might be missed. And if I see any errors, I let them know. And that's our starting point. So Bob walks in and he hands me his 1040. And he has a sole proprietorship. So he does a Schedule C, if you're familiar with the Schedule C for your business. It's all part of the personal tax return. And on line 30, which is the home office deduction, it's blank. And I can't tell you how often I see this, a lot. The other scenario that happens is that on line 30, it shows $1,500 or something around that amount. Let me see if I can get, okay. So there is two ways to calculate home office. One of them is a simplified method where you just take your square footage of your office space and you multiply it times $5, and that's it. Okay, super easy. I never use it, ever. The reason is because the maximum you can take is $1,500, and every one of my clients has more than that in home office deduction. Actually, $4,000 to $5,000 is the average. That's a lot of money being left on the table if you use the simplified method. So Bob walks in and he's either got a 0 or he's got a 1,500 on here, right? How did the 1,500 even get there? Well, this is what happened to Bob. He brought in his tax return. He brought it in late to his tax preparer. April 1st, he walks in the door and hands the tax preparer their stuff, okay? Tax preparer is ripping their hair out. They're burnt out. They're tired. They got to get this return done. And Bob forgot about giving him the home office information, okay? So Bob's doing the return. It's midnight. He can't call the client right now. So he needs to get this return done. He's got a big old stack of returns set in here that he's got to finish up, right? So he takes the shortcut. Well, I know that Bob probably has about 300 square feet to his office space, so I'm going to use this safe harbor method and throw $1,500 on there, okay? And I'm going to show you Bob's actual numbers here in a minute so you can see how much money did he leave on the table by using the safe harbor. Oops, keep hitting the wrong one here. So on the 1040, the home office is actually reported in detail to the IRS on a Form 8829. So the square footage, the business use percentage is figured on it, and all of the different house expenses that we get to take are reported. I want to talk about the S corporation, partnerships, and C corps for a second, okay? Because this home office is available to them if it's done as a reimbursement. And what happens is, since there is no actual Form 8829 to fill out, and there is no line item on the corporation return, this deduction often gets missed. Also, it's missed because it takes planning to do the home office reimbursement, because you do have to pay that out throughout the year. And if that doesn't happen and you don't have an accountable reimbursement plan in place, then you would lose it in an audit. So it often gets missed. So let's say Bob walks in with his corporate return, his 1120S. He's an S corporation. He hands me the return. I look through it and I'm like, Bob, where did you get the home office deduction? And he says, yeah. And I said, well, I don't see it. He looks through it and he says, well, I'm sure I did, because I gave my accountant all that information at tax time. And so here's what happened. The accountant knows that he can't take it on an S corporation return unless it's done through a reimbursement, and so he just left it off. So he missed it completely in that case as well. So I'm going to challenge you guys when you go home just to take a look at your returns and see what the heck happened with your home office, okay? So if you're a Schedule C, look at your line 30. And if you are an S corporation or a partnership or a C corporation, see if you can find it. Or ask your preparer if they took it. All right, so Bob, he owns a 2,000 square foot home. He uses one room for business, and that is 300 square feet. So his business use percentage, so you take your business use of the home office divided by total square footage, is 15%. Okay? So he can deduct 15% of all of these expenses: your mortgage interest, your real estate taxes, your utilities, your repairs and maintenance on the home. He painted his house this year. Insurance on your home. Lawn and landscaping's included here. HOA dues. And then you get to take some depreciation, which is the cost of the home plus any improvements over the years, divided by 39 years. And you can see the depreciation number is the second largest number on here.
Yeah.
And here's the deal. People think, well, I don't want to take depreciation. There's a recapture later, and I don't want to do it. Well, the code says that you have to recapture any depreciation that was allowable, whether you took it or not. So let's take it. Don't lose it. Okay, so we got $36,900 of home expenses. Personal expenses you're paying for anyway, multiply times 15%, and he gets a $5,543 deduction. So if he left it off of his return completely, it cost him $1,663 in additional tax. And if his accountant took the shortcut, the safe harbor, and did $1,500, he only got $450 of tax savings, and he should have gotten $1,663. So again, he left $1,213 on the table. So here's what happens when I'm talking to him. I say, okay, well, let's look at we can go back 3 years and amend. So what had happened the year before? Same thing. And what happened the year before that? Same thing. So if I go back 3 years on him, and let's say, $1,213, the lower amount, $4,500, $4,600 in his pocket, is that right? $3,600 in his pocket? Right. So, and then he gets to take that going forward as well. So the next thing that I usually do with a client around this particular topic is I help them maximize the home office. So to maximize it, if you increase your business use percentage, you get to take more of all those home expenses, right? 36,000 times 20 or 25% is a lot more, right? So how do we increase the business use percentage? Well, the no-brainer way is, of course, to increase your office space, or don't forget storage. And we get creative. We talk about areas of the house that aren't being utilized right now, and how could we include those, right? So that's kind of everyone kind of knows that kind of thing. But what a lot of people don't realize is that another way to increase a business use percentage is to decrease the total square footage of the home. Well, how do you do that? It is what it is, right? Just demolish one of the bedrooms or something. And I have another way, and that is, a lot of people don't know this, but you can leave out of the calculation of total square footage your bathrooms, your hallways, your closets, and any unfinished areas, and even staircases. So think about that. what that could add up to, right? Hallways, bathrooms, closets, staircases, and unfinished
Like
areas.
the whole house.
I know. My walk-in closet, heck, get that out of there, right? Yeah. So Bob and I start working together, and he learns that he can exclude all these things. He didn't know that. So we recalculate it. And now he only has 1,500 square feet total instead of 2,000. So now he's at a business use percentage of 20%. So what happens to his deduction? So he was going to save $1,663. Now he can save $2,217. That's actual tax savings. His deduction is $7,391. Now I use 30% because he's in a 24% federal bracket, and he's got a 6% state. Well, if we look at Idaho, it's close to 6, right? Yeah. So 30%, that's what he saves. So $554 that one thing put in his pocket. So, and again, there's so many things, right? So, I mean, like, this is a lot of fun. This is really what I'm passionate about, is we can find a lot of these things and add them up, and oh my gosh, it's thousands and thousands of dollars. So, S corporations, they do have to have an accountable reimbursement plan in place. So this is something I do with my clients. We set these up. And I love to teach clients to reimburse themselves for everything. So we reimburse every month for home office, and we reimburse for mileage every month, and we reimburse for cell phone, and we reimburse for internet at home, all these things, right? And it's money that actually flows in from the business to the personal bank account. It gets booked on in the bookkeeping. It shows up on the profit and loss, and it feels like you're getting paid, right? You can use that money for all your personal expenses, and you can actually ultimately lower your distributions that you're taking by way of taking all this money in reimbursement. So if you don't have reimbursements, you're not going to get the deductions. So there is planning involved here. You really do miss out on it if you don't get it set up properly. Some people take it anyway, but if you were audited, you'd lose it. I've been there, I know. The first thing they ask you in an audit, if you are an S corporation and you have home office on your return, they say, well, okay, well, I want to see the accountable reimbursement plan. What? And then they lose it. Or I want to see where the reimbursements happen. Show me in the bank account. Where did you transfer money from the business to the personal for reimbursement? So all of that has to be there. If you take it anyway, there's a high risk of losing that in an audit. So, all right, so I'm going to open up the floor for a minute. Does anybody have any questions on home office?
I have a question.
Yes.
Go ahead, Cody.
I have a
got like
question
6
on
questions.
just on
Only
that
one.
reimbursement. So I've heard
Yeah.
the problem with that is you're moving money from the business to your personal. So now are you getting income tax, just personal tax on that?
You are not.
reimbursement?
Yeah, that's
No?
great question, but no.
Okay.
Nope, that is not income. That's a reimbursement, and it's not taxable to you.
Cool.
Yep.
Yeah, it's technically output first.
Yeah.
So it's just being made whole.
So I have an S corp,
Yes.
and so I put myself on payroll.
Right.
Would you recommend doing the reimbursements through the payroll system?
You can do it that way. Some people like it because it just makes it easy. I like automating things as much as you can. So you could set it up in your payroll just to automatically do the reimbursement as part of that payroll. Yeah. Then you don't have to think about it anymore. Yeah.
Definitely if you have a space, not your dining room, or
Has-
part of an office, it has to be totally.
It does have to be an exclusively used, regularly and exclusively used for business. And again, those are loose terms, so we talk that through. I help you to figure out whether you really qualify or not,
And
and
you
how to
mentioned
qualify.
storage, so storing,
Storing stuff, yes.
okay, so how does
Yes.
that, oh,
Store it when you store your things. Lay it all out on the floor, really. Don't store up.
Horizontal, not vertical. That's awesome.
yeah, so, but it's, the storage is in another area of the house?
Doesn't matter. That's
Doesn't
fine.
matter?
Yep.
Okay.
Any part of the house that you're using for business, you can take that as part of your business use percentage.
But garage,
Goodness.
would that
Oh,
count?
through your whole house?
Garage, it can. If you're not using it at all for business and it's unfinished, you can leave it out. But if you are using it for business, then you would include it in the total and in the numerator as business. Yeah.
When
Yeah.
you're doing something like reducing the square footage,
Yeah.
are you not just asking for an audit? Like, do they start? I would
No.
feel like that would be a pretty.
It's not asking for
triggering,
any audit.
you
No.
know?
No. People change homes all the time. Things change in the, in the space. No, it's not an issue.
Cool.
Yeah. Yeah. And remember, I mean, if you're a sole proprietor, you are giving all that detail to the IRS. But if you're an S corporation, you don't. You don't give them anything. There's no 8829 form. And I honestly just put it into office expenses, So it's not, there isn't even anything that would trigger anybody looking at the return to know anything about your home office, so, yeah.
So you didn't mention W-2. If you're a W-2, can you not take that deduction?
Unfortunately, back in 2018 with the tax law changes, that went away.
Yeah.
Conveniently, I just thought of this yesterday, and maybe I shouldn't even express this, but I thought, well, that was convenient. Just before COVID happened, they took the employee home office away.
Right. Right, exactly.
I'm not saying, I'm just saying.
Now, if, let's say because that was an example.
Yeah.
Let's say my home office is 144 square feet. Let's say it's a 12 by 12 room.
Yeah.
Then am I wanting to take the 1,500 or am I wanting to still go through the math? And
This is a great question.
Let's add this into it.
Yeah.
I'm a homeowner and I don't have a mortgage, right?
Okay,
so that
right.
big expense goes away as well.
Yes. So yes, what I do with clients is I run it all ways and all the different ways, and we figure out what's the highest. So in some,
Perfect.
Actually, I can't tell you that I've ever had a situation where that was higher.
Yeah. Okay.
But I mean, I'm not saying it's impossible. It is. Or if you rent, or if you don't have a very big rent, or something like that, that could be possible. But I haven't had one client do that.
Great.
So.
Great.
I love what I'm hearing here. If you've been in business for a while, which I have, since age 26, you figured the math. Couple things happened. I finally came across a good accountant. This is Southern California, Seal Beach. And he went back 3 years because a lot of accountants take the safe approach.
Right.
They don't like to be audited. And he got me back so much money doing that.
Yes.
Next thing is, I'm going through a divorce. So remember, all the bad things happen. And I get a bill from the IRS for $110,000.
Yikes.
Okay, now the way they work is insidious. You cannot talk to the same person twice. So they send you a form, you reply. They send their original form, your reply, plus a new one back. This goes back and forth for a long time, where the packages that you're getting are this thick. Okay, so my accountant can't figure out why. My bookkeeper doesn't know why. And now they're seizing 3 of my properties to pay for this. And I'm in a 90-day period. On the 89th day, I go in to see a tax attorney, and that cost me $1,800. And he says, Nils, some of your clients are filing 1099s on your social security number and some on my federal ID number. Well, I'm saying, can't they add the 2 together? But they're claiming one is unclaimed taxes. And he says no. And then he put it, he filed, put a hold on this. I get to keep my properties. He says, now the IRS will call you. And they will meet with you face to face, and I still remember his name, Jeff. So I go in with my shoebox. Okay, but these are all P&Ls and this and that. They're not
right.
loose receipts.
Right.
And he says, I think you're right, but let me just go through these. Okay, and that was a mistake.
Yes.
Because the tax attorney says, I'll go with you. I said, I can't afford you. What I should have said is, fine, which receipt would you like to look at? Okay, because this process goes on and on. I meet with Jeff 4 different times. They dropped it to $68,000. How would you like to do that? Credit card, check? I go, and then I said, look, no, I paid my taxes. I'm not paying it. Based on what? And then I took that to my bookkeeper and accountant. They said, oh, it's this. I go 4 friggin' times. The last time was $1,600. I said, I'm not paying it. He says, Jeff says, I figured you'd say that. Let's just write this off.
Yeah.
But look at that process, plus a divorce, plus other actions that come with that. That was a nightmare for me.
Right.
So having the right accountant, starting with the one that I went to in Seal Beach, that saved me all this money, and then moving forward, it can get crazy with the IRS. And one last thing, I've known a couple IRS people, and for them, it's a badge of honor. I mean, how many people, how many victims they can create. They just don't really, I mean, they're keeping a kill score back in those offices. The second thing is, there is a standard test that they take when they come in, and these are tax issues, okay? And there's only one number that's correct when you go through and process. Less than 90% get it right. And if they're doing your taxes from the IRS side, just know you're in trouble. So having the right person is the right thing.
Yeah. Do I have any more time? Just to wrap up?
We've got about 5 minutes here.
5
if you wanna-
minutes.
Yeah.
I'm just going to wrap up really fast.
Go ahead.
I did have another strategy I was going to share, but I'm just going to move really quickly through that. Oops. To kind of to the end. I was going to talk a little bit about the FICA tax and entity selection. A lot of you are aware of an S corporation, right?
Yeah.
And how that works with FICA taxes. I have another strategy I often use with clients called the limited partnership that also accomplishes the same thing. And basically what it does is it works for married couples, and it allows for you to have one partner as a limited partner who is passive. And so if we have that partner owning 49% of a limited partnership, then the business owner is the active partner owning 51%. So 51% is going to be subject to FICA because FICA is only on earnings. And 49% is not subject to FICA because it's flowing through to the spouse. It works because a married couple is going to file everything on one tax return anyway. So it's one of those workarounds where we can still get FICA taxes saved. And this works great for someone who is where their salary is already eating up all of the S corporation earnings or all the S corporation net income, so there's no benefit. The limited partnership is an alternative that will allow you to still save FICA taxes. This is great for people who aren't big enough yet to justify the additional expense of payroll for an S corp. They can do a limited partnership because there's no payroll here. So it eliminates that headache and you still get the savings. You are just really limited to 51-49% split, so you can't, you can't take that any lower as the business grows. But we can always switch it to something else later, right? So you start with a limited partnership and grow into an S corp down the road. So that's that. This is an example of that, and it just shows that he would have had $19,000 of FICA at $120,000 of income, and using this limited partnership, he's going to save $9,364 in FICA taxes. Now, this is just a net income of $120,000, and his FICA is $19,125. It's 15.3%. And this is how business owners have a hard time staying in business when they're new. If you're in let's say you're in a 24% bracket, and then you add 15.3% for FICA to that, and then you add 6% for state income tax, we're at 45% of your net income going to income and FICA before anything else, right? So a new business has a hard time staying in business because of taxes. So I just wanted to show you that if you go to my website, which is taxplanningpros.com, I have a free report out here that actually goes through these two strategies I talked about in detail, and I also have a third one out there. So feel free to go there and pull that, and you can read and just get more detail about that, and check your own tax returns and see what's occurred. Does anybody need my business card, or did I get everybody? One? Okay.
I just want to ask one question.
There you go. Yeah, you're welcome.
How many
Yes.
people want a copy of this video?
Well, thank you guys for the time. I appreciate it.